Today we're looking at the largest new buy in Warren Buffett's Berkshire Hathaway's stock portfolio. So this is the largest new company that they added to their stock portfolio, and that company is Royalty Pharma. RPRX is the ticker. In this video, we're going to talk about sort of the initial figures that I've come across, because honestly, I knew nothing about this business before I started looking into it. And now I'm looking at a company that's largely unrivaled, trades at around 10 times free cash flow, and is growing at 20%. That type of setup definitely smells super interesting to me. I haven't pulled the trigger yet on Royalty Pharma, but given that it's part of the Berkshire Hathaway portfolio, there's a real potential that there's a lot of deep value here. So I want to understand it in greater detail. In this video, we're going to explore what's Royalty Pharma's business model and what the opportunity might look like. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Let's dive right in to understand. But first, in full disclosure, this is not financial advice. At the time of this video publication, I did not own stock in Berkshire Hathaway, and I did not own stock in Royalty Pharma. RPRX is the ticker. And so, first of all, Berkshire has been a net seller of stocks so far this year. And so I was super curious, what are they actually buying? They've been a net seller of about $6 billion net year to date. And so what are the new positions that they're adding? And RPRX, or Royalty Pharma, that is about a $500 million new purchase. It's fairly insignificant relative to their portfolio, given that you're looking at a multi-$100 billion stock portfolio. That said, it is a meaningful part of Royalty Pharma's market cap. You're looking around 3% of the market cap that they bought. So, it does strike me as, okay, so they are interested. In all likelihood, this likely was not Warren Buffett's purchase, but probably one of his top lieutenants like Ted Weschler or Todd Combs. And so to understand Royalty Pharma, they partner with all the key players in the biopharma ecosystem to buy royalty interests in new blockbuster treatments. This ranges from academic institutions like UCLA to global pharma behemoths like Pfizer. Okay, so why would anyone want to sell a royalty interest on a on-patent solution? I mean, effectively, when you're selling a royalty interest, that means you're giving away whatever percentages that come straight off the top. So you're saying whatever sales of a new treatment, this is a royalty that's going to be going to Royalty Pharma. So why would these major players like a Pfizer or like a UCLA or these charitable foundations or small and mid-cap biotech companies, why would they sell these royalty stakes in these treatments? And the reality is there are a lot of reasons to do so. For example, these royalty trades can help with diversifying asset portfolios. You think if you're a major institution, academic institution, you're expecting to get these cash flows over, let's say, a 20-year period, you can swap that out with an upfront cash payment that leads to more funding for scientific research in the near term, or accelerating a new product, pipeline for potentially new developments, or for other companies that might be looking at huge cash burns like various different biotech companies. It might be a form of non-dilutive capital where they could say, hey, I currently have this treatment that's likely to come to market. I don't want to have to issue new equity. Instead, I'm going to offer a royalty exchange. So there's a lot of different reasons. Another possibility is related to M&A in terms of reducing M&A costs if you're selling maybe part of the portfolio as a royalty. And the reality is this is a really sizable market opportunity. It makes me wonder if this is even an opportunity for Berkshire Hathaway to acquire this company in whole, because, hey, could this become a form of capital allocation for Berkshire Hathaway? Here it is. This company has deployed, Royalty Pharma has deployed nearly $20 billion since 2012, and the vast majority of the products are approved. Now, at the time, at the status of the royalty acquisition, only 56% of the products were approved, whereas 44% were in development stage. But this does show sort of the specialization with management and their abilities that at the current status, the vast majority, over 90%, are approved products. So that means they're making bets on things that they have high confidence will ultimately become approved. Now, there is a trade-off with this where approved products are going to have a lower return profile than something like a development stage where there is a little bit more risk, like, hey, how's the clinical data going to play out for something like that? We'll talk more about that risk reward dynamic in a bit. Now, management is also agnostic to the type of treatment. So it's not like, hey, we're just looking for royalties in oncology or neurology. It's wherever there's a potential attractive return on capital, and it just depends on who's available and what treatments are out there, and what do they think it looks like from a competitive dynamic. Now, I'd suspect one of the core challenges with this type of business, this royalty business, is that you're perpetually offsetting a portfolio of treatments that go off patent and lose a lot of their economic value. When a treatment goes off patent, the economic value or the underlying revenue tied to it can drop like 90% plus. And so this is a very difficult aspect to this business model. This is unlike, let's say, Berkshire's investment in owning Burlington Northern Santa Fe, their railroad, asset, that while their core, physical assets depreciate over time, the physical railroad will depreciate, the franchise itself will generate increasing free cash flow over time, and you likely don't have these sort of patent cliffs where the free cash flow just drops precipitously, unless you have some sort of economic effect. You don't have this like, oh yeah, in 5 years from now, this is going to be worthless. I mean, you do have that with individual assets, but it's the broader franchise should have dramatically increasing free cash flow over time. Now, management, going back to thinking about, okay, so you do have this risk that you have to deal with. You do have to understand that there are different type of royalties. Management pencils out high single-digit and low double-digit unlevered return targets on approved royalties. So that means they're looking to make, potentially 9% to, let's say, 13%, low teens, on an unlevered basis for the approved royalties. So something that's already been approved to go to market. This implies that by using debt, which they've been able to do very cheaply, get 2% debt, you're probably looking at a potentially high teens, maybe 20% potential returns. That's annualized, 20% annualized returns. So that is really interesting. Obviously, you'd have higher return potentials with unapproved royalties. They talk about teens rates, so maybe that's like 14 to 17%, and maybe that goes to high 20s when you use debt to acquire them. The challenge here is, once again, is that you do have debt maturities that will need to get paid down, and ultimately, if you're in a period of higher interest rates, that will be a double-edged sword of like, yeah, you're going to have to deal with higher interest rate payments over time. Now, while I was initially skeptical about this potentially being an unrivaled business model, it's also super possible that Royalty Pharma, once again, RPRX is the ticker, that they're unrivaled. I mean, they are the largest royalty portfolio in the marketplace, and they can leverage that entire portfolio on a consolidated basis. So if I were to try to compete, let's say on a private equity basis, I'd have a smaller portfolio and I'd only be able to leverage a particular portfolio, like a much smaller, maybe individual structure, whereas they got this much bigger diversified bet. And this leads to much cheaper debt financing than their competitors. So they might be looking at low single digit interest rates, whereas competitors are looking at high single digit to double digit. So that is a real financing cost, a true cost advantage. And this ultimately might reinforce management's strength and specialty in pharmaceutical royalties, where they deliver on, hey, finding the next big blockbuster or finding treatments where they say, hey, this is an attractive risk reward for us. Now, what's the valuation, as I think about this, earlier I mentioned around 10 times free cash flow. Is this an attractive risk reward? First, a quick plug, where if you're interested in following along with my personal financial journey, go to unrivaledinvesting.com. Each month I call out potential multi-baggers as well as my personal portfolio. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So if you're interested, once again, go to unrivaledinvesting.com, click join the journey. And if you enjoy learning about potentially exceptional, potentially unrivaled companies, please make a point of hitting that subscribe button, hit that thumbs up button. And so as we think about the valuation here, looking at Royalty Pharma, RPRX, management is effectively guiding to nearly 20% growth this year and around $1.8 billion in free cash flow. That's sort of what they're penciling out for the free cash flow, given that RPRX has nearly $20 billion market cap, around $18 billion. This implies a 10 times free cash flow multiple. So normally I'd say, okay, folks, back up the truck, 20% growth, 10 times free cash flow. But the challenge I'm having here is understanding how much of this cash is actually really free. This gets back to the patent expiration aspect, is that how much of that 1.8 billion is really free versus needing to repay the future debt maturities, given that the royalty interests and patents ultimately do expire. And they talk about how the average life of these royalty interests is around 13 years. So that is sort of a challenge that I'm mentally working through, and that's part of the reason why I haven't pulled the trigger, is that it's sort of tough to think about this aspect of the business. Either way, investors currently in RPRX, so the current shareholders, you're making a huge bet on management and their ability to parse out the economic value of approved and pre-approved, so potentially approved treatments. There's a lot of optionality here. The potential for a new blockbuster treatment, they talk about potential, asthma. They've got a full calendar of potential, new, results, phase 3 results coming out in the fourth quarter in 2022. So those things could all be meaningful catalysts for the company where they could say, hey, yeah, our growth profile is even better, or, we're looking at much better free cash flow in the year ahead. I'm looking at this in all honesty, I'm looking at this and I'm thinking, for now, this strikes me as being just a little too tough, a little bit outside my circle of competence. It's tough for me to think about that sort of treadmill of running, borrowing a ton of money, having to repay that. You're going to have this patent cliff in the future. It's just easier for me to think about, this business, I'd rather find companies that, it's either, it may not have that sort of clear free cash flow profile of like, hey, 1.8 billion, but it's, I'm looking at this and I'm thinking how much of that 1.8 billion is actually going to get returned to shareholders. I recently called out to my Unrivaled Investing Journey subscribers a company that trades at 30% discount to book value. So a 30% discount to book value has a long history of beating the market indices. And I'm thinking, hey, if they just execute, let's say in the next 5 years, this potentially has 200 to 300% upside. So that's relatively easy for me to pencil out. Something like this where it's like, well, what multiple should this get given that the patents are going to expire? That is tougher. That said, they have done a really good job growing despite some of these patents expiring. Something like around 13% of their portfolio did expire this year, and they're still managing to grow nearly 30%. So the reality is, I think I don't know enough at this point. If you have a strong opinion on the royalty pharma space, royalty pharma in particular, if you think there's an angle here that I'm missing or a different way to look at it, I'd absolutely love to hear your thoughts on this, because honestly, when Berkshire Hathaway's buying, you're usually looking at something that's potentially deep value or very attractive risk reward. I just can't get there quite yet. Maybe that's a mistake. Love to hear your thoughts. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching.